Hey guys, happy 4th of July weekend. I hope everyone's having a good day so far. So, I'd like to provide a little bit of a roadmap from the Fed and what you may end up seeing in the future, because past may end up being prologue to an extent. And as we all know, coronavirus has caused some major panic around the world with all the shutdowns and businesses closing and just overall chaos. And this chaos has been led with massive fiscal and monetary policy to keep the liquidity pumps moving around the system. So this roadmap from the Fed, there's some interesting policy tools in here, and some analysis has been done by Scott Minerd, the CIO of Guggenheim. I tend to really enjoy his work because he is clairvoyant in what he sees. Generally, over the long term, what he predicts has come to fruition. So in his policy outlook, he went over a couple of the topics you see here on your screen: and forward guidance, formal QE, yield curve control, negative interest rates, equity purchases, and gold. So obviously, seeing gold pop up in his outlook kind of perked my interest, being somewhat of a gold bug, if you will. So we'll go over these topics here and show you kind of what is looking forward. So a couple points on forward guidance. Forward guidance, first and foremost, is a policy option that is nothing more than the Fed expecting to raise interest rates for a period of time, and not expecting to raise interest rates for a period of time. So where we are now, the market already is pricing interest rates staying very close to the zero bound for the next 5 years. There's not going to be very much shock and awe if the Fed announces that it will keep interest rates at zero for 2 or 3 years. The Fed could commit to maintaining rates at the zero bound for at least 5 years and possibly longer, subject to the average inflation rate needing to exceed 2% on average over a 5-year period. And mind you that the CPI that they measure it in is not what you and I deal with every day. We have consumer prices at the highest rate they've been in 50 years. So they've adjusted it using CPIU, and it has to do with bracket creep, where they did this in the 80s, where the inflation eats away at your income, and because it slowly slips into the next income bracket, but in real terms, you're actually losing. So technically, you're paying more taxes on less purchasing power, which is a total crime in itself. But additionally, this approach would have the benefit of automatically extending the expected period at the zero lower bound if economic conditions worsen or the recovery falters. So that leads us into formal QE, which is the Fed just buys treasury bills to try to keep interest rates at a lower level. And by having those interest rates at a lower level, they're able to finance the government more effectively. And what happens is, right now they're roughly buying $125 billion per month, and that's insufficient to absorb the $170 billion in net monthly treasury coupon issuance we forecast for the rest of the year, let alone the hundreds of billions of monthly net treasury bill issuance that we expect. So the trade-off here is that committing to the zero bound for a period of time through forward guidance could raise inflationary expectations, which means that longer term rates could rise. The rate sensitivity of the mortgage market and the importance of the housing sector to the overall economy means the Fed is not going to want to see long-term rates skyrocket. So that brings us to gold in this chart on the left. And there's no coincidence that low interest rates are good for gold. Gold is essentially becoming a zero coupon bond now, where traditional 60-40 stock bond portfolios they don't perform the way they used to. Bond portfolios don't buffer the stock market anymore since they're both structurally at historic prices. The bonds are going to be paid back in nominal terms over the long term, but in real terms, your purchasing power will be destroyed. So as you can see, the gold price has moved up quite a bit. I think structurally, you're seeing bondholders realizing that owning gold as a zero coupon bond in a nominal world is actually a great way to structure a portfolio. So you're going to be able to get the nominal price appreciation plus the real term appreciation, hopefully, but it will always outperform the bonds because of the nominal price appreciation. But it's very interesting to see that Muhammad El-Arian had some comments on gold, and he said some signs that the rally in gold reflects more than the usual drivers, a gradual structural shift among investors regarding the gold and long-term asset allocations as a result of the very low yields on government bonds associated with central market interventions. So it's very interesting to see that. And another policy tool that we may end up getting into is one that was used in the 40s, and that's yield curve control. Essentially, yield curve control is where the central bank would not allow interest rates across a portion of the curve to rise above a certain rate. The Fed could announce a rate, say 50 basis points, and state that it stands ready to purchase all treasury bonds of a certain tenor above that level. The Japanese government is currently engaged in yield curve control, and we did it here in the United States in the 1940s to help finance the war. The experience of yield curve control here and in Japan demonstrates that once the Fed announces that there is a put to the central bank at a certain interest rate level, it will not buy many securities. So yield curve control could prove an interesting tool to limit money supply growth while keeping interest rates low in the event of a sudden surge of inflation. So the only difference that we would have this time is back then, the US economy was structurally in a much better position. The debt level was much lower, savings were much better, but today we all know that debt levels are very high, interest rates are killing people, so they have to go lower to do that, and people aren't as self-sufficient as they were back then, so it would cause a lot more problems now, but it brings us to gold again. If you look at this chart here, if you adjust gold for inflation, the CPI that they tell us is correct, but it isn't. If you can see that 15% higher from here would break a ginormous cup and handle formation, and that would lead us to probably $3,000 gold, where you're seeing more and more analysts predict that may happen. Bank of America said $3,000 on gold. I don't see why it can't happen, especially with bond investors looking for bonds, and gold can be that zero coupon bond, and we know that governments are printing currency at a feverish pace, so I don't see why that can't be a possibility. And with negative interest rates coming, and we don't know if it's going to happen for sure, but it's most likely going to happen because they have no other way out. That brings us to Jerome Powell saying that will never happen, but the Fed and everybody else thinks that markets can't give us negative interest rates, but it's not like the Fed provides a permit in order to allow bonds to trade at negative yields. The reality is that the market can do it. For example, in Europe, the ECB policy rate is negative 50 basis points, and German Bunds have traded below negative 80 basis points, meaning the Bund yield curve has been inverted. Even if the Fed keeps the Fed funds rate trading at 5 basis points, the Bund relationship shows that the US Treasury yield curve could invert and trade at negative rates. Yield curve control could prove an interesting tool to limit money supply growth while keeping interest rates low in the event of a sudden surge of inflation. And it's no surprise that you look on this chart right here that the yellow line is gold and the blue area there are government yields to maturity inverted. So if you look at it, gold and interest rates move almost identically. It's very interesting. So you can see that zero coupon bonds may be gold now. And this brings us to a more politically charged topic, which is stock purchases. The Fed could reasonably buy stock. They're already buying junk bonds and high yield government bonds. They're buying Apple bonds. They're buying corporate bonds across the curve. So what may end up happening is the Fed could create a special purpose vehicle like they did with bonds to buy stocks and to keep the market afloat. But that will remain to be seen. I don't see why they won't. It's not like they play by the rules anyway. And this chart here shows the strong correlation between stock prices and corporate credit spreads. If stock prices were begin to slide, this would mean that corporate credit spreads could widen. So as these widen, we get into some problems where companies go bankrupt. Not that it matters anymore because the Fed tries to bail everybody out, but you can't solve a solvency problem with a liquidity problem. And last but not least is gold. And it's interesting that he had a perspective on gold. So central banks around the world, including the Fed, hold almost 35,000 tons of gold reserves. There are no signs the world is questioning the value of the US dollar, but it is clear that it has been slowly losing market share as the world's reserve currency. With the Fed going all in on financing the government deficit, the US dollar could be at risk to negative speculation of its status as the dominant global reserve currency. And it's been no surprise that banks around the world have been accumulating gold to back their banks. I think they see the writing on the wall of this time of fiat currencies being debased. And you can see the currency composition of official foreign exchange reserves in this chart right here. It's slowly winding down, and I don't see why it won't continue to move down, especially as the US keeps printing and dropping interest rates. So by them accumulating this gold, it shows that some kind of new monetary agreement is most likely coming. They've happened every 50 years or something like that. And gold is the tether that puts all these charts together, and it puts all these central banks in check. And I leave you with this PowerPoint from the World Economic Forum, which has an interesting take on what's coming. And I'm not sure when that is, but